Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And Ramsey, we are just kind of blessed with the guests that either come on or, better yet, are on once and then come back. So, do you want to introduce and set up our discussion today?
Absolutely. So we're delighted to have David Blanchette rejoin us again. We were just saying before the show, it's probably been more than a year, and Dave is one of those guests that we hope we can have on, a lot more often than we have. So be careful what you wish for, David. You're going to get a lot more invites down the road. Great to have you back. A lot has changed since the last time you were here. You've taken on a new role at PGIM as part of the Prudential family. You're the director of retirement research there. You are publishing prolifically on LinkedIn and in various trade magazines. So everybody has really the benefit of seeing all the the amazing work you're doing. We'd like to today just chat about sort of your perspective on a number of the various trends in the market. But anyway, with that, I'm going to hand it over to you to fill in any blanks I left out in terms of what your key focuses are right now, and then we can just dive into some of the first topics.
Yeah, it's great to be back. I think you covered it. I've been at PGIM/Prudential now for about a year. I have a very similar role, of course, where I was at Morningstar for about a decade. I'm, primarily focused on the DC space and DC solutions, but I think that spans everything. I think if you're going to give someone advice about their 401k savings, you got to think about everything. So while I'd say that our group is focused on DC, it's, you can't not think holistically about financial planning to give the best advice. So.
Yeah.
Fantastic. Go ahead. Go ahead, Paul.
Yeah. So I last time you were bold enough to give us some predictions about what the future held. We will not pull those back, test them, but we appreciated that. So I guess I'm thinking of a song from the Talking Heads. This will date me. It was, it ends, the lyrics end, oh my God, how did we get here? Like, wow. I think of where we are in the insurance industry. We never thought we'd see interest rates go up. They have. Inflation, really? We never expected inflation, or certainly didn't expect inflation where we are today. I don't think we would have seen the market perform the way it's performed over the last couple of years. I mean, if you were to, talk to people and say, this is the state, here's the state of the retirement market, what is it? Where are we, and how did we get here?
I mean, I would say it's a bit of a hot mess right now. I mean, if you look at 2022, right, I mean, bonds are down, stocks are down, inflation is way up, crypto is way down. I think it's crazy. I mean, if you had told me 3 months ago, or we'd have 10-year government bonds at 3%, I'd say that's nuts. And so I think that right now is just a really interesting time for investors, for insurers, for everyone. There's a lot of opportunity out there, but also, I mean, it's going to be, it's not clear that the market has reached a bottom. It's not clear where rates are going to go. So there's just a lot of uncertainty right now.
So with all that backdrop, there are a number of different things that we can sort of hit on sort of one at a time. So one is inflation. Another one is, the rate environment, and maybe we should dive a little bit deeper on that one in particular. And we were talking a little bit about that before the show, that in a world where rates are both unpredictable in the moment, and also they can seem to be very low and move very high. Like, how is that? What are the implications for the insurance industry and what you think products might look like in the coming years?
Yeah, I mean, I think that one thing that I've been looking at very recently is how insurance companies have responded to the rate increase, right? So there's obviously lots of structural components to how annuities are priced, but the market rate environment is very important. And for example, if you look at like the daily volatility or changes in rates for MYGAs, the dispersion or variability across providers right now is the highest it's ever been in this data set going back about 4 years. And I think all that's really saying is that insurers are responding to today's environment very differently. I'm hoping to get some data soon from CanX to explore like SPIAs and DIAs more, but that makes sense, right? I mean, no one knows where rates are going to be a week or in a month. And so I think that what you're seeing is just insurers are going to lean in or lean out of certain products. We've already seen that happening in certain spaces, like for GLWBs. I mean, net overall, higher interest rates are good, but I think it affects, obviously, insurance companies differently.
Fascinating. MYGAs, right there. Interesting topic. And we as a carrier, we've been trying to position our MYGAs, okay, we have the rate setting meetings. We say, okay, we're going to target, this rank. And David, like before we even like push the email out, it's like, oh, okay, we're now going to be 6th, 7th, 8th, 9th, 10th in some of these marketplaces. So, how long do you think this will go on? Well, first of all, how high can MYGA rates go? Because I've heard people, we've talked to people on the phone and the agents say, well, the minute the rate goes to 4%, call me back. Okay, we're right. And then wait 30 days and like, oh my gosh, it's over 4%.
Right.
How long? How long is this and how high will we go?
So I have no idea, right? The current rate environment, I've been absolutely shocked at. I mean, I would expect, MYGAs to be at a premium over 10-year bond yields, but I mean, what if 10 years go to 5%? What if they go to 6%? What if, I think to me, what's attractive about MYGAs is they are guaranteed, right? They are tax advantaged, but I think what will really set the rate for the MYGAs is just the market overall. I wouldn't think we would see rates higher than 3%, but I wouldn't have thought we'd be at 3% 3 months ago. So I'm not sure that my predictions are valid, at least in the near term, around current rate movements.
What about on a relative value basis? You'd also mentioned, prior to the call, we talked about, so rates for MYGAs are going up. What are you seeing as sort of the relative attractiveness of MYGA rates versus other alternatives now versus before? So they're higher overall, but on a relative value basis, how do things stand?
Yeah, so I mean, this is some research that's been ongoing with Michael Fink, who's at the American College, for over a year now. And so, if you think about MYGAs, right, there's issuers of varying levels of financial strength. There's a very, positive relationship where the lower the financial strength rating, the higher the effective payout rate on average, right? There's obviously differences within a given band. What you can look at then, for example, is you can match the financial strength rating from AM Best to like a bar cap index, and you can look at, how do corporate bond yields, for example, of a similar duration/term compare to MYGAs? And I know that it's totally apples and oranges because like the corporate bond yield is like the best case scenario. There could be defaults, all this other stuff. Well, what we have seen happen over the last 3 months, especially, is that gap come down. So what you saw, maybe if you go back a year, MYGAs were yielding 100 basis points-ish over a comparable corporate bond index. And so that to me is that is dynamite. I mean, that is a guaranteed, locked-in, no-vol return. Today we're in an environment where it's not necessarily a push, but they aren't dramatically outperforming. You could argue, an incorrect proxy, but to me, like the relative value of MYGAs over corporate bonds isn't the same, but they're still destroying, like CD rates are still like 45 basis points on average. I know that there's some out there that are over 200 basis points, but still, I mean, from my perspective, MYGAs are still an incredibly attractive, option for investors who want a very safe investment today.
Yeah, and I guess it's all kind of leads us to inflation. We've got rates, we've got inflation. I guess going a slightly different angle than taking a slightly different angle than Ramsey did. If I'm a retiree, I'm 68, which is typically the average age of one of these MYGA buyers. Corporate bond, I guess you can't really go out and buy a corporate bond as an individual. David, how do I sort of think about all the different product choices I've got? I want money. I'd like to get the interest. However, 4% today may sound great until I realize that inflation continues at 7% for the next 3 years. So effectively, I'm going back. Is this the time that retirees should say, look, I want to actually put more money into the market more money into the market as opposed to electing for one of these, safe money choices.
So, I'm less concerned about allocating to a MYGA that has like a 3 or 5 year term. Like that's not like a permanent decision. I think to me where there's maybe a high level of concern is like buying like a SPIA or a DIA, right? I think that we all know this, but there are no guaranteed lifetime income products that have an explicit like COLA for inflation. And so if I go out today and I buy a SPIA, and we see inflation to your point that is 7% a year for 5 years, well, that is going to be worth a lot less at age 95. And so I think that if anything, what it does is it would give me some pause, to just be honest, on buying purely nominal benefits. And so like this is an environment where because of the uncertainty with inflation, delaying claiming Social Security is a lot more valuable. But then also just any kind of strategy that does give you some kind of link to inflation, whether even if it's implicit, which is kind of I think where more of the insurance space is moving to, where there's different types of benefits that do allow some potential market growth.
So, all right. So we were talking about we're also talking about indices, and obviously indices have proliferated dramatically over the course of this point. It's actually been 10 years since the first one came out, if I'm not mistaken. And as I've said before on the show, I that was a business I was previously involved in. I mean, what are your thoughts on where we've come with that, David, thus far? And where you think things are going to go. And I will mention that our lead sponsor of that annuity show, the Index Standard, it focuses very much in this space and provides a lot of fantastic background. So I just want to make sure that we acknowledge that before we start the conversation.
Well, I think we need more companies like the Index Standard. I wish Morningstar was doing what they were doing. I wish that other organizations were doing what they're doing, because I think that when you see product innovation or solutions, you got to ask, well, like who is it really benefiting? Is it helping the end user, or is it helping the insurer, or both? And to your point, there's a lot of crazy indexes out there now, and they can make some client proposals, some hypotheticals, all that look really attractive, but I'm not convinced that the actual user of that indice is going to benefit long term. So I get why some of them exist, but what concerns me is how they're presented and how they're illustrated, simply because I worry that people are going to see these and think, oh, wow, this thing has gone up, 15% a year for the last decade, and they're going to extrapolate it out into the future, and that's just not a realistic forecast at all.
Yeah, it's a slippery slope. A lot of reasons why carriers put these indices together and create them, and a lot of good reasons. Some obviously to differentiate products, others to try to mitigate risk and create the highest yield. And one set, maybe we talk about just briefly, even one set of indices that are all that have become very popular over the last couple of years were these low vol indices. I mean, what's the future here of indices, index strategies in that bucket?
I mean, I think that they like there's an obvious reason why they can and should exist, right? I think that yes, I think that is great. What has worked won't necessarily work as well in the future. And again, from my perspective, I'm less concerned about what index you're using versus what you're illustrating. You mentioned the Index Standard. They have a report they put out. I saw the one for 2021. They have their forecasts for a given index versus the actual historical average. I would much rather every insurance company have to use, for example, what they put together versus what the actual history has been. Because I think my concern is not necessarily like you can create whatever you want. It's the concern that, how realistic is this well back tested index going forward.
So would you be more bullish on the proprietary indices over the next 2 years, or say, the market's going to revert towards maybe custom versions of indices that have been around for a long time, S&P 500, NASDAQ?
Well, if the market keeps going down and I want to sell something, I don't want to show a market that's been going down. So one could actually argue that, even if their utility is potentially even less because you're super back testing, it's going to look better in illustration. Right. So, I don't know where the market's headed. I think that really, even the S&P looks spectacular, right, up until recently for the last decade. So you didn't necessarily need to pick something else. Well, if the market goes down for a year or two, there's going to be a vested benefit in selecting some kind of index that no one owned but would have done well had you owned it, recently?
Look, I wanted to shift gears a little bit here, as I wanted to talk a little bit about I guess maybe new things you're working on, in your current role versus at your prior role. What are some of the key areas that you think are that you're going to be focusing on, strengths for the organization, or you think are important in the coming years?
So, I mean, it all very much rhymes what I'm working on now versus what I was working on before. I talk about almost all the exact same things. One thing that I'm a big fan of is just personalization, is just helping individuals get advice and guidance, or a strategy that better suits their needs. I think that target date funds have been a spectacular improvement in the DC space to help move participants away from self-direction, but they're still not very personalized. I'd love to see utilizing more of the information you have on participants in a DC plan, beyond their age. You got their income, their savings rate, their balance, their plan tenure, their gender, possibly, it's all this information, give them a better strategy. Then also kind of like bigger questions, like the role of protected or guaranteed income in terms of a retirement strategy. Does it belong in a DC plan? Where's the industry headed? I think there's a lot of questions that we haven't answered, but to me, it starts with personalization. If you make $20,000 a year and have a $5,000 balance, you shouldn't buy an annuity. And I think, one of my concerns is that if you attach an annuity to a target date fund, everyone gets it. Well, you don't necessarily need it. So I think that, if we're going to move to the DC space with more guaranteed/protected solutions, it has to be a smart methodology to figure out who needs it versus just saying, hey, everyone who's 45 gets half their balance invested in this product.
Yeah, no, we have a different podcast for our incubators focused on retirement and related topics. And Symetra, we're actually doing a series in partnership with Symetra on the future employee benefits. And Dave, you kind of alluded to how you change behaviors. What's the future of the whole savings market at the employee level?
Well, I mean, I think that DC plans have been not a raging success, but I mean, there's clear evidence that the DC plans help people save more, and this is, you see this globally. I think that we've done a really good job in terms of the investment side of things. Obviously, we can improve things. I think that savings is where the biggest gap is today. I think that while employers have been shifting more towards automatic enrollment, it's still rare in smaller plans. I think that people need to be saving more, but what this will hopefully create is an environment in the future where the 401k is the predominant place that individuals hold assets. One problem right now really is that when people leave their jobs at any point in their career, they exit the plan, and so you have DC plans that aren't necessarily the true savings of someone throughout their life cycle. Well, if we can get to that point, I think it creates an environment where you can really give better advice and guidance on what they should do with their accumulated savings.
Well, so it's a very interesting point you bring up, David, because it is true that at retirement or termination or whatever the reason is somebody leaves the company that they take the money with them, but arguably the plans aren't really all that well designed to keep retirees thus far. So, it's as you talk about that journey, and you and I have talked about it offline in various situations. The role of sort of mandatory allocations, and then the potential benefits down the road of personalization. I think ultimately we're kind of we're asking the DC plan community to build an entirely different infrastructure and, frankly, culture than maybe is there already. I mean, what do you think it's going to take for us to get them there? Because if you want to stay in plan, you can do that, but there may not be the services you would really expect that you would have if you rolled it over to an IRA, at an entity that was better designed to service you there.
Yeah, so I mean, I think that to your point, like what has to happen first is plan sponsors, aka employers, have to care. And I think that if you go back 5 years, there's very clear evidence, like PIMCO does a survey every year, most plan sponsors did not actively look for participants to stay in the plan post-retirement. That was just not something that they even wanted. They viewed it as a risk, okay? That has dramatically changing. So if you put plan sponsors into 3 camps, kick them out, I don't care, keep them in, the the two groups that are growing the most are the keep them in and I don't care camp. And so what's happening is that plan sponsors are starting to care a lot more about keeping folks, in a plan, not just post retirement, but post terms of employment. So they're, that is changing. So I think that like there is that first domino to fall where all of a sudden they are adding more investments, adding advice, adding partial withdrawals, thinking about guaranteed income. They're actively asking questions. What do I need to do to keep people excited about staying here when they leave employment? And so that to me is the first step in this process. Now, to your point, a lot of plans still don't do this. A lot of smaller plans aren't going to go there, but we are seeing a very big shift in the industry where plan sponsors are, especially for retirees, actively looking at ways to keep them engaged in the plan.
Yeah, Ramsey mentioned personalization. I think it's a great step that people are getting these income statements that are starting to roll out. I've talked to a couple of people who've received them. I'm still waiting, for it for a couple of my stranded 401k plans. David, if you kind of went through and said, here are the 5 things that we could be doing as an industry to get Paul Tyler to put more money into this, let's take the mandatory stuff aside. What are the most promising, ideas or concepts out there right now?
Yeah, so I actually have some new research as well, looking at like the interaction between like match rates and automatic savings. And I think there's a very easy thing that the industry could do: automatically enroll all participants at like 8 or 10%. It's funny. People talk about the Pension Protection Act of 2006 and how great it was. Well, it actually resulted in significantly lower savings for many Americans because the default savings rate was 3%. That was just a terrible anchor for so many people. We are seeing plan sponsors move, to higher rates, but it's still not even 6% on average. So I think what we need to see happen is just plan sponsors, it doesn't have to cost them anything. Even if you don't have a match, the simple act of, automatically enrolling folks and having a high default will result in higher savings rates. So like that to me is like, that is number one. If you want to improve outcomes for participants today, that's what you should be doing. Because no one knows where rates are headed, what market's going to do. But if you're not saving 15%-ish all in every year, you're going to have to make adjustments to your lifestyle when you retire.
Uh-oh.
So, I mean, it's a very important trend, and again, I'm on the same page with you. I think that this can be the future of retirement, an important part of the future of retirement. There's just so many steps between between here and there, and balancing sort of the mandatory nature, just getting people into something versus getting them to a place where it's a more personalized offering. I mean, how far away do you think we are from being able to provide, really effective personalized offerings? I mean, there's some startups in the space that are working on it. Some of whom I'm sure have been on Reimagine with Paul. But how far away do you think we are from being able to do that? I think it's a fantastic ideal, but is it 2 years, 5 years, 10 years? What do you think? How long before we get there?
I mean, there's tools that have been doing this for decades, right? I think the question really boils down to is the cost, and I think that's been the big hurdle for a lot of plan sponsors and consultants. And so I think the key is driving that cost down, not necessarily to zero, but so that it's an easier decision versus using, maybe a more prepackaged solution like a targeting fund. So I don't know. I'd like to think we're already actively seeing, institutions do this. But I mean, if I had to guess, I think every asset manager within 3 years will have some kind of personalized solution they're offering, maybe to even replace target date funds. So as opposed to buying, the Vanguard target date series, you're going to buy the Vanguard customized portfolio plan that uses the employer information, and opposed to having just, like a 5-year vintages, you get a highly personalized allocation. Yeah.
Well, another crystal ball question is, at what point, pick a number that annuities have a meaningful penetration rate among plan participants. I don't know. You can tell me what meaningful is. Ramsey, I would say 10%. I think 10% would be of participants having an annuity would be an enormous accomplishment.
That would be a huge jump from where we are now.
Yeah, right. I know, David. So, I guess let me ask this 2 questions. What is meaningful, for the industry, and then second is what's the time frame? Is this a 3, 5, 10-year march to get there?
Well, so I mean, the problem, right, is that if you add an annuity window or whatever to a DC plan, no one ends up using it. And so I think that you see that maybe 10% of plans that exist today have option to some kind of guaranteed income strategy. No one ends up really using it at all unless it's part of some kind of default investment. So I think that's where things get really interesting, because what you want to do is you want to, I think, focus on older participants and get them, excited about having protected lifetime income. But then I think there's interesting problems there, right? You want to make sure that it's at least somewhat personalized. Again, if you only make $25,000 a year, why do you want to have more guaranteed income? And also, there's also just this fact that, if you were to ask me, well, if you don't have any affirmative information about someone, where should they go to buy guaranteed income? I would say, well, they should delay claiming Social Security. So it creates, I think, a complicating factor where, why would I assume you'd buy a product? Again, you haven't told me anything about yourself. You're just being defaulted before I first kind of exhaust your savings via delay claiming Social Security. So I think we're getting there. I think we're going to see more solutions. I think that the rate environment has a big impact here. If interest rates pop up and they radically change the way that we do Social Security, that would dramatically change the math about the value of delay claiming versus buying a private annuity. But in today's marketplace, Social Security is linked to inflation. That is super valuable right now more than ever. Right. So, do I want to buy a product that's nominal versus real? I want a real product. And so, for me, I love protected guaranteed lifetime income. It's just that if you're offering it in an environment where you don't have affirmative information about someone, and there's a better solution out there, at least today, how do you recommend something else versus delay claiming Social Security?
Yeah, I guess I agree with that. I agree with that principle, but when I look at when I look at the advisory space, whether it's fiduciary advisors or it's folks that that focus on selling insurance products, that the optimization around Social Security before answering that next set of questions around whatever product those parties have to offer is not as standardized as maybe it should be. It's just been my observation, right? Like I think that the problem sort of seems to exist everywhere in one form or another.
Yeah.
Well, I've research coming out looking at just claiming decisions among individuals, respondents in the 2019 Survey of Consumer Finances. And you would think that if you have an advisor, and there's three different types of advisors that you can, well, more than that in the data set, effectively a broker, a planner, or an accountant. You would think if you have an advisor that you would claim later on average, right? Advisors should be well aware of the effect or the benefits of Social Security. If you have a broker, you on average have more wealth than the average household, but you claim about a year or two earlier than the average person. And so, I don't know if that's just because the brokers don't know about the benefits of delay claiming Social Security, if they're actively selling against it, right? Because it's you're competing for assets effectively. I mean, the only winner when someone delays claiming Social Security is going to be the household, right? It creates fewer assets to manage. And so, part of the concern that I have, and you see this in materials that my advisors is throwing doubt on Social Security, is saying, oh, what's going to happen here? You should buy this. And, to me, there's a lot of uncertainty out there. And I think, no one knows what's going to happen. But I do wish that more advisors, were actively thinking about the benefits of delay claiming Social Security versus using private products. Again, I really like annuities. I'm not saying that I don't. I just think that in terms of the rank order, today there's kind of like financial planning alpha that's there that might not exist longer term, that more advisors should be helping their clients take advantage of.
Yeah, I saw one kind of interesting Israeli startup that actually has a platform that makes it easy for me to actually include Ramsey's active 401k plan inside my ADV and actively manage his employer's 401k plan. Is that a growth opportunity, or is it one of these sort of small niche things that will work for certain high net worth individuals?
So what I don't like about our industry right now is that for most of advisors, for them to get paid, they have to roll the money out of the 401k plan and move it to an IRA. And that might make sense in some instances, but some 401k plans are awesome. Like if you're at IBM or these massive plans that have phenomenal investments that you could not buy in an IRA, like stable value and private real estate and everything else, why would you roll out of a plan? And so I really like the idea. I mean, if you're going to have an advisor, right? I want them to, they have to get paid. But I like the idea of companies that can allow, participants in DC plans to stay in the plan and they still get paid, because I think that that's in a lot of investors' best interest. It gets the advisor paid. They have to get paid. I get that. But they don't have to leave the plan then. So the more solutions that exist that can do that, I think the better the industry could possibly be.
Hear, hear.
Well, listen. This has been great, Dave, to have you back on here. I guess Ramsey, final thoughts, questions for David.
Well, I with the overall thoughts, I just want to say thanks for all the work you do. You cover lots of areas. You're very thoughtful. You're focusing on DC. You're focusing on planning, and I think. I've always sort of appreciated the consistency you bring to the equation as you think about, what makes the most sense and the questions you raise. So thanks for that. On the personalization issue, I like it in the long run. I feel like the first natural step to that is probably people end up getting a default allocation that sets the stage for people having some amount of assets saved. And then you move, once there's an established base, a broader established base of people that have actually have money saved, personalization can potentially take off. But I feel like it's a two-step process. I don't think we have enough infrastructure and people in place for that to work effectively yet. So I think it's the future, but I'm thinking 5 or 10 years in my head.
Yeah,
that's my only thoughts.
And David, I guess just for our listeners, you've got a lot of fans here. What's next? What's the really exciting topic you're looking at? You mentioned MYGAs. Is that the top of the table right now?
Sure. Actually, MYGAs are kind of cool, but what I think is maybe really cool is just where the insurance industry is headed. Well, not just the industry is headed in terms of protected longevity solutions, right? So, SPIAs have been around for thousands of years. DIAs are somewhat new. You've got GLWBs; they're kind of out of favor. I just think that insurers are adapting to the current marketplace and creating different types of solutions. I call them protected lifetime income benefits, or PLIBs, but you could group a tontine in there. You can group lots of things in there that I think allows, again, to use the word personalization. I think people benefit significantly from having income that is protected for life. You don't have to worry about outliving your savings now, but people can take different levels of flexibility around what that payout looks like. A SPIA is very straightforward, right? You're gonna get X dollars per month or per year as long as you live. Well, what if inflation's huge? What if I have the ability to cut back if I need to? And so I think that the more that you have solutions that allow kind of this continuum of risk sharing, the more you can kind of create personalized solutions that work best for each person versus you have to buy a SPIA. Well, we all already have SPIAs. We all have Social Security. I think that layering solutions on top of that are protected for life but aren't necessarily fixed really can improve the kind of the efficiency of a retirement strategy.
Oh, hey, this is great. So where's the best place for people to stay in touch and follow you? Clearly LinkedIn. Where else?
Probably just LinkedIn.
Okay.
I'm not too much on the Twitter that much these days. So I think that if anyone wants to see what I'm up to, what I'm working on, I think LinkedIn is the best place to find me.
Okay, terrific. All right, David, thank you. Ramsey, thank you. And
thanks.
And
appreciate it, Dave.
Hey, yeah. Listen, we want to thank our listeners and keep giving us feedback, and we'll give us ideas for guests and topics. Appreciate it, and join us again next week for another episode of That Annuity Show.
See you guys.